Hey guys, welcome back. Jeb Smith here. In today's video, we're going to talk about an update that just came out that could benefit a lot of home buyers out there using FHA loans. For those of you who have tried to get qualified using FHA and have student loans, you've likely encountered a problem in the way they calculate your student loan balance. Well, today we got an update that FHA has now updated their guidelines with regards to student loans, with regards to how they're calculated, which should allow home buyers that were considering using FHA, a minimal down payment, 3.5% or so, to qualify, or at least have a better opportunity of qualifying. And so I brought in my local mortgage professional, Josh Lewis. Many of you guys know him from our weekly lives where we talk about the housing market and real estate and mortgage and what have you. And so I thought we'd ask him some questions and perhaps he can give us an example of what it actually looks like when using, the previous guidelines versus the guidelines now, because I think this is really, really important and can allow a lot of people that were on the sidelines, that needed to use FHA and couldn't qualify to now do that. So Josh, welcome to the show. Why don't we start by talking, where things were originally and then maybe where they are now. And then you can give us an update on an example, if you will.
You cannot understate how important this is for anyone with student loans and a credit score under 680. And for people in the 680 to 740 range, it's probably still really important. And we'll go through the examples and the numbers. But yeah, talking about the history of this, going back to say prior to 2015, no one had ever heard of income-based repayment student loans, income-driven repayment, pay, repay. There's even another name for it. There's 5 or 6 different names that the government uses to refer to programs that allow you to pay less than a fully amortizing payment on your student loan. So from a lender's perspective, this is an issue because they want to know you have this loan. Your car loan is for 60 months. At the end of 60 months, it goes away and we have a fixed payment. On the student loan, the government has said, hey, you owe $200,000, but you only make $50,000. We'll take $125 a month. And that obviously does not ever pay off the loan, probably doesn't even pay the interest off. So this became an issue around 2015, 2016, and lenders started going, not even lenders, the people that insure the loans that lenders make, Fannie Mae, Freddie Mac, FHA, VA, USDA, had to start wrestling with this. So the interesting thing is in 2015, for the first time in about 30 years, FHA completely rewrote their underwriting manual. And in 2015, the new 4000.1 underwriting manual came out with one of the craziest things I've ever seen. They said in here that you had to use 2% of the outstanding loan balance. And basically that just means no one's ever qualifying for an FHA mortgage with student loans. Because if you had a $50,000 loan, that's $1,000 that we're going to have to hit you with in terms of a payment. They did, to their credit, fairly quickly realize, hey, 2% is insane. An amortizing payment is never anywhere near 2%. Let's go back. And they said, so you would use either the greater of 1% of the outstanding balance of the loan or the monthly payment reported on the borrower's credit report or the actual documented amortizing payment. So for anyone with an income-based repayment, you were essentially looking at 1%. So we're going to dive in here to an example. This is a client that we're dealing with right now. So when I say there's a problem, I mean, we personally at Buywise Mortgage talk to 2 to 4 clients a month who are either pre-approved or thought they were pre-approved, or like this lady in escrow, and find out that their loan officer didn't understand FHA guidelines, didn't understand student loans, qualified them with the payment showing on their credit report, and then they get in process. So Karen, the lady we're going to talk about here, she is actually in escrow to purchase a home, supposed to close in about 2.5 weeks, and her loan officer had told her, well, sometimes we can use less. We can use the lower payment. We can use the income-based repayment. So under the prior guidelines, never an option. It's a hard and fast rule. You're going to use 1% or you can use a fully amortizing payment.
Right.
So for her, she was looking to buy a $500,000 home. She makes $75,000 a year, and she has $70,000 of student loans. So that $500,000 home, 2.5% interest rate on an FHA loan puts her right at $2,900. So
Wow.
just under 47% of her income going to the housing payment, which is acceptable under FHA guidelines. Now the problem becomes with her $70,000 of student loans, she only has a $100 payment. So with the $100 payment, she qualifies just fine because on an FHA we can go all the way to a 57% debt to income ratio. But as soon as we calculate it at 1%, that's $700 there. That's more than 10% of her income. That takes us from a 46 and change on the front end to a 58 on the back end before we add in any other debts, cars, credit cards,
Right.
anything else she may have bought. So in her instance, dead in the water. So the critical part to understand for her, with a sub 680 credit score, just under 680, you can get great terms on an FHA loan. You don't get great terms on a conventional. So the option was we could go Fannie Mae or Freddie Mac, which will allow a non-zero IBR payment. And in that instance, in looking at it, the difference in rate was between 2.5 and 3.375, so almost a full percent. The FHA loan has 0.85% mortgage insurance. The conventional loan, if she did 3% down, was 1.31%, or if she wanted to come with more down and do 5%, it was 0.92. So to try and do apples to apples, if we switched her over from FHA to conventional, we go from a $2,900 payment to a $3,250 payment. So
Wow.
$350 extra. It's not even an option for that person because first of all, now for her, blows the debt to income ratio. We can't qualify her. So we need a way to use FHA financing using the income-based repayment. So essentially what FHA announced today is that they're going to follow Freddie Mac's guidelines, and they're slightly different than Fannie Mae. And it's important that we discuss that difference because there is still an instance where you might get pushed to having to use Fannie Mae.
Right.
So what they're going to do right now, they'll take the payment amount reported on the credit report or the actual documented payment as long as it's not zero. Now you say, well, of course it's not zero. Actually not. I've had a lot of people come through with an income-based repayment where the government says you do not have a required payment. It's zero. Now for FHA, if it's zero, they're not falling back to their old 1%, but they're saying we would use 0.5%. This matches identically to Freddie Mac. So in that instance, let's say if our borrower here, if the 0.5%, let's say she owed $150,000 on her student loans, the 0.5% would still blow her out of the water. The only one that will accept a zero monthly IBR payment is Fannie Mae. So in her instance, if that were the case, we would still look at having to go with the Fannie Mae loan, but these options are much, much better, and it makes it simpler for loan officers. And that's important because the reason why we get so many calls on this is most loan officers have no idea what the student loan guidelines are. And they tell you, hey, I looked at the credit report, I looked at your pay stubs, everything's good. And you get into escrow and you go, oh shit, I'm in trouble.
No, and you said a couple of important things here, and you know, in order to keep this video short, we're not going to go into a lot of detail here, but allowing home buyers to now take whatever's on the credit report and or 0.5% in some cases is going to allow a lot of people that couldn't qualify for FHA to now use an FHA loan to buy a house, which is huge. That's going to create more demand in an already crazy housing market, but the one thing you mentioned that rings to me and stands out is, the fact that she went to someone initially that didn't understand the guidelines, right? If you're watching this video, you follow my channel at all, I often preach working with a professional, working with somebody that understands, that's an expert. This is case in point of why you need to make sure who you're working with actually understands the guidelines, because this person was in escrow. They were qualified per se. They were pre-approved, if you will, based on somebody that supposedly knew what they were doing and gotten to a point where they could have lost their deposit if they didn't truly, understand it. It just, it just, I guess, infuriates me to some extent that there's people out there doing loans that don't truly understand them and putting people in a position. Or on the other hand, you could have somebody that, was going to write an offer and that mortgage person on the other side said, you don't qualify because of X, and they didn't understand how to calculate it. Maybe they didn't know about the update that comes out today and they're still calculating it based on the old guidelines and say, hey, look, you can't qualify using FHA. Whereas if you're working with a professional, somebody that follows the guidelines, follows the updates, you're going to be kept, up to date, up to speed, and they're going to be able to make sure that you're in good hands. So went off on a little tangent there, but it's something that is important to me, is that you're working with an expert, whether it's on the real estate or mortgage side. And this is, one of those times that I think it stands out and makes a lot of sense to do that. So, if you want to talk to Josh, if you're in California, I'll put his contact information in the comments below. If you're looking for a professional in another state, you can click the link in the description below as well to get connected. Anything you want to add to this, Josh, as we're leaving and trying to keep this update just an update?
No, really. What I would say is just follow up on what you're saying in terms of working with the professional. There's two types of ways you can get on the wrong side of this. Dealing with a person that doesn't know the guidelines and doesn't know the question behind the question. I tell everyone that I'm like the last of the old dogs in the mortgage business. I started in 95. In 1995, we did not have automated underwriting. It came out around 1997, wasn't really prevalent till about 2000. Anyone that came in the business after 2000, it's really easy to pull a credit report, plug in the income numbers, run the automated underwriting, and it's garbage in, garbage out. So things like this, where her payment would show as $100 on the credit report, if you don't know to ask, is that a fully amortizing payment or an income-based repayment, you get on the wrong side of it. And unfortunately, there's a ton of loan officers that don't know to ask that question. So it's just important. There's a lot of things that are behind the scenes that you wouldn't necessarily know to tell your loan officer. And if you're not with a loan officer that knows how to ask and clarify those things, you can get yourself well into a process and have your heart set on a home and find out that you don't actually qualify for it.
No, absolutely. So if you're looking to buy an FHA loan or looking to buy a house and use an FHA loan, make sure you're working with a pro. Reach out to me if you need one. And then lastly, as we're finalizing here, if you're new to FHA, you're new to student loans, and you just happen to come across this video, you want to know the additional guidelines, check out this video here where we talk about 2021 FHA guidelines. It'll tell you the specifics of what you need in order to qualify using an FHA loan. But for now, I appreciate you taking the time to watch. Appreciate the support. See you again soon. Have a great day. Bye-bye.